Country risk and the management of country risks. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. Country risk and the management of country risks are discussed in this video. In this video, you will understand the meaning of country risk, the importance of managing country risk by businesses, country risk assessment, types of country risk, critical considerations for the management of country risk, risks associated with international business, questions for boards on the management of country risk, and factors multinational firms should consider when faced with high-risk country risk situations. Now, let us start. What is country risk? Country risk, also known as sovereign or political risk, is sometimes called the risk that economic, social, and political conditions and events in a foreign country will affect an organization's current or projected financial condition or resilience. Country risk refers to the uncertainty associated with investing in a particular country, and more specifically, the degree to which that uncertainty could lead to losses for investors. This uncertainty can arise from several factors, including political, economic, exchange rate, or technological influences. Country risk connotes that a foreign government will default on its bonds or other financial commitments, increasing transfer risk. In a broader sense, country risk is the degree to which political and economic unrest affect the securities of issuers doing business in a particular country. Country risk is evident in all international activities and can affect several categories of risk. This is because a country's risk is a broad measure that captures the risks of conducting business activities in a foreign country. Hence, country risk is closely associated with strategic risk. Country risk comprises the various risks of investing in a foreign country, leading to either investment impairments or reductions in returns on investment, ROI. For example, investment impairments may arise from confiscatory actions of a country through the nationalization of business and expropriation of assets. ROI reduction may arise from discriminatory actions by a sovereign directed to the company, a targeted industry, for example, energy or banking industry, or companies from some countries, for example, through payment of additional taxation, price or production controls, exchange controls, currency manipulation, expansion controls, performance requirements and other regulations. Both may arise from destructive and disruptive acts by others such as violence, terrorism, war, strikes, infrastructure deficiencies, kidnappings, and physical phenomena. The importance of managing country risk. The primary objective of managing country risk is to protect company investments in foreign markets and sustain acceptable investment returns. Country risk is critical to consider when investing in less developed nations. Political risks have increased due to the great turmoil created in financial markets. Consequently, political instability can affect the investments in a country. Such country risk can reduce the expected return on investment, ROI, of securities issued within such countries or companies doing business in such countries. Investors may protect against some country risks, like exchange rate risk, by hedging, but other risks, like political instability, do not always have an effective hedge. Foreign direct investment, not made through a regulated market or exchange, and longer-term investments are susceptible to the most significant potential risk of country risk. Thus, when analysts look at sovereign debt, they will examine the business fundamentals by examining what is happening in politics, economics, and the general health of the countries that is issuing the debt. To manage country risk, a multinational company should identify, measure, and monitor risks and control its level of exposure to foreign countries. The board of directors and senior management must ensure adequate oversight and maintain an effective system of controls over the company's international activities commensurate with the activity's volume and complexity. Country risk management with multinational companies tends to suffer from one or more of three common defects. 1. Country risk and its varieties are not adequately defined, making it difficult to understand the nature and size of country risk exposures or set limits. 2. The estimation of country risk is distorted by a misleading method for allocating exposures to countries, that is, chalking as it is commonly known. 3. The absence of internally developed and thus transparent country risk models makes it difficult to respond adequately to the changing global macroeconomic landscape. Assessment of country risk. Country risk assessment, also known as country risk analysis, is the process of determining a nation's ability to transfer payments. It considers political, economic, and social factors to help organizations make strategic decisions when conducting business in a country with excessive risk. Most investors think of the United States as the benchmark for low country risk. So, if an investor is attracted to investments in countries with high levels of civil conflicts, like Argentina, Venezuela, Mexico, and South Africa, for instance, the investor should compare his own country risk to that of the United States. Professional analysts who will assess such risk would often use MSCI index data for correlation coefficients to measure the effect of country risk in a particular location. By the way, MSCI is a leading provider of critical decision support tools and services for the global investment community. Types of country risk. Country risk assessments can be classified into different categories based on the factors discussed earlier. Let us consider some of the most common and what they mean to determine how they impact multinational clients' transactions. 1. Political risk. Political risk determines a country's political stability, either internally or externally. For instance, a recent military coup would increase a nation's internal political risk for businesses as rules and regulations suddenly shift. Other risks in this category could include war, terrorism, corruption, and excessive bureaucracy. That is, the host government red tape is preventing certain fund transfers or other transactions. Political risk can affect a country's attitude to meeting its debt obligations and may cause sudden changes in the foreign exchange market. 2. Sovereign risk. There is some crossover between political and sovereign risk, although the latter, also known as sovereign default risk, primarily examines debt. Sovereign risk measures the debt obligation of a government and its agencies and how the government anticipates fulfilling these obligations. For example, if a government agency refuses to carry out debt refunding, this could impact local lenders and lead to losses. This would, of course, have roll-on effects on local businesses and anyone undertaking trade with them. 3. Neighborhood risk. Neighborhood risk, also known as location risk, may not be the direct fault of the country with which a company's clients are dealing, but instead is caused by trouble elsewhere. This might have spilled over effects on other sovereign nations, creating turmoil in the foreign market and pressure local lenders and businesses. Neighborhood risk may arise through geographic neighbors, trading partners, co-members of certain institutions and organizations, strategic allies, and nations with similar perceived characteristics. 4. Subjective risk. Subjective risk is not a term used everywhere. However, it measures factors common to most risk assessments, and it could significantly impact foreign business owners trading with a host nation. Subjective risk is about attitudes and can include social pressures and consumer opinions on certain types of goods and organizations. 5. Economic risk. Economic risk encompasses a wide range of potential issues that could lead a country to renege on its external debts and cause another type of currency crisis during a recession. A significant factor here is economic growth measures based on the health of a nation's GDP and its outlook for the future. For instance, if a country relies on a few key exports and the prices for these are dropping, this creates a negative outlook and may increase the economic risk for foreign trading partners. Government actions can also impact economic risks, such as intervention in the money market and policy changes that cause tax instability. Foreign currency exchange can also impact economic risk, for instance, a shortage in certain currencies or a devaluation of the exchange rate. 6. Exchange risk. Any predicted loss created by sudden changes in the exchange rate is generally covered under the exchange risk factor. This is another all-encompassing term, as fluctuations in foreign exchange can be caused by a wide variety of factors. The economic and political factors discussed can be significant drivers of exchange risk, although currency reserves, interest rates and inflation are also potential factors. One example of political change that can harm economic risk is a change in the currency regime, for example, a fixed regime to floating 7. Transfer risk. Transfer risk is another significant country risk assessment factor. This is where the host government becomes unwilling or unable to permit foreign currency transfers out of the nation. A significant example of this occurring is the Malaysian credit controls after the 1997-98 Asian currency crisis. Total controls such as these may be a side effect of a nation in crisis attempting to prevent creditor panic from turning into a significant capital outflow. Regardless of the cause, capital control can prevent foreign traders from retrieving profits or dividends from the host country. Critical considerations for management of country risk. The turmoil in the Middle East has demonstrated that once governments undertake confiscatory or discriminatory actions, mobs take to the streets, or civil war breaks out, crisis management and damage control options available to a company are limited. Country risk comprises the various risks of investing in a foreign country, leading to investment impairments or investment return, ROI, reductions. The primary objective of managing country risk is to protect company investments and sustain investment returns. Because events in high-risk countries can occur with little warning, companies should regularly analyze the portfolio of countries in which they operate. A practical country risk assessment requires evaluating such factors as political stability, financial stability, economic outlook, and exposure to corruption. Unfortunately, this assessment often lacks precision and is rarely integrated into a proactive decision-making process. Some companies rely on research firms that can provide indices offering an indication of relative risk. However, this data often lacks guidance or suggestions as to precisely what decision-makers should do. One reason is that extreme high-impact, low-likelihood events are simply unpredictable. Let us discuss some factors multinational firms should consider when faced with high-risk country risk situations. Risks associated with international business. Country risk is a broad measure that captures the risks of conducting business activities in a foreign country. Country risk is closely tied to strategic risk. Countries are vulnerable to three general types of crises: sovereign default, exchange rate, and banking system. Currency devaluations, foreign exchange controls, and other political actions such as nationalization or asset expropriation can affect domestic and foreign banks. Currency devaluations increase a bank's exposure to credit, price, and liquidity risks. On occasion, country risk concerns in one country may spread to other countries with similar characteristics or where risks can be transmitted through trade linkages or the financial markets. A currency crisis in one country that spreads to neighboring countries and trading partners could increase a bank's exposures to price risk through an unexpected increase in market volatility across asset classes. This situation is commonly referred to as contagion risk. Using banks as a case study, risks associated with an international business include credit risk, interest rate risk, liquidity risk, price risk, operational risk, compliance risk, strategic risk, reputational risk, information and technology, IT, risk, cybersecurity risk, and emerging risks. Now, let us discuss risks that are associated with an international business using on banks as a case study. 1. Credit risk. In international activities, credit risk is amplified by country-specific macroeconomic and political developments, including movements in exchange rates. A devaluation of the local currency can negatively affect obligations that borrowed in a foreign currency if revenues for repayment are generated in the local currency. A unique form of credit risk in international activities is sovereign risk. Sovereign risk is the sovereign, or government, obligor's likelihood of defaulting on its financial obligations. The default may be indicated by any of the following: 1. Failure to pay principal and interest fully and on time. 2. Accumulation of arrearages. 3. Restructuring or rolling over of debt. Or 4. Inability of the country to meet its external debt service obligations, actual default. In general, the government may be unable or unwilling to pay its debt. For example, the government may make a unilateral decision to default on its debt for political reasons, such as Russia not recognizing former Soviet Union debt. Alternatively, the government may be forced to default due to inadequate reserves of foreign currencies or a banking system crisis that leads to an exponential increase in sovereign debt that it cannot serve. In the case of Greece, the primary cause of default was fiscal mismanagement that led to an excessive debt level that precipitated debt and banking crises. A similar scenario played out in Argentina in 2001, which also included a currency crisis. Some factors in the assessment of sovereign risk include the levels of short-term external debt, the amount of international reserves available for intervention in the foreign exchange market, and the role of foreign sources of funds in meeting the country's financing needs. Before the global financial crisis of 2008, emerging market countries were the focus of sovereign default risk concerns. Since 2008, developed countries, such as Greece in 2012 and 2015, have also experienced sovereign defaults due to the restructuring of their debts. Therefore, the country risk analysis process should cover all countries, including developing countries in which a bank operates. The depth of analysis should be commensurate with the volume and complexity of exposure. 2. Interest rate risk. In international activities, interest rate risk is amplified by country-specific macroeconomic and political developments, including sudden and significant increases in interest rates. The causes of sharp interest rate movements can vary. For example, sudden changes in central bank target interest rates can be motivated by a desire to defend the local currency from speculative attacks or in response to an inflationary shock. Even without changes in the central bank's target rate, investors selling government bonds to avoid the possibility of a sovereign default can cause large increases in securities price volatility. In an unstable economic situation, securities of any maturity can be easily affected, whether in local or foreign currencies. 3. Liquidity risk. In a country context, liquidity can be a significant risk that banks should anticipate and manage, especially if a country is susceptible to a crisis. As noted previously, countries are vulnerable to three general types of crises, that is, sovereign default, exchange rate, and banking system, resulting in systemic liquidity issues. In the first instance, a bank may not be able to liquidate assets quickly and at a reasonable price if other banks and institutional investors concurrently recognize the deterioration in the economic and financial conditions. Depending on the situation, the local interbank market can become dysfunctional. In a worst-case scenario, the central bank can declare a banking holiday that closes the banking system for a short period, usually 1 day to 1 week but possibly longer. This situation occurred in Cyprus in 2013 and in Greece in 2015. In addition to a banking holiday, particularly in situations involving a depletion in foreign exchange reserves and possibly an exchange rate crisis, the central bank could prohibit banks, businesses, and consumers from exchanging local currency for foreign currency, resulting in liquidity risk for the bank's operations. Cross-border risk can amplify the liquidity risks associated with international activities. Cross-border risk exists when any foreign unit of a United States, U.S., bank, for example, a branch or a subsidiary, has assets or liabilities, on the balance sheet or off-balance sheet, that are not denominated in the local currency. For example, there is a cross-border risk if a foreign branch of a U.S. bank is funded in U.S. dollars through head office accounts. Capital and the ability to repatriate it also represent cross-border risk. Cross-border risk encompasses convertibility and transfer risks. Convertibility risk exists when the ultimate source of repayment cannot convert its local currency into the foreign currency of payment due to government restrictions or actions. Similarly, Transfer risk is the possibility that an asset cannot be serviced in the currency of payment because government action limits foreign currency transferability, for example, Venezuela's imposition of foreign exchange controls in 2003. Another form of liquidity risk, ring fencing, occurs when foreign regulators require capital and local deposits to remain in the country. Liquidity and capital trapped in the local country are unavailable for transfer from one foreign branch or subsidiary to another or the parent. 3. Price risk. Country risk can amplify the price risk associated with banks' international activities. For example, sudden shifts in actual or perceived country risks can adversely affect the value of a bank's securities. They can have secondary or incidental effects in foreign exchange and commodities markets, depending on the country. If the situation in a country devolves into a crisis, even the pricing of loans, including syndications, can be affected. Further, government and central bank actions or contagion from another country can amplify price risk in any given country as investors sell securities in anticipation of the risk of the first country affecting the second country. The contagion risk could be transmitted through a financial channel to trading portfolios involving products or derivatives through an increase in interest rates or depreciation of the exchange rate. 4. Operational risk. Operational risk is the possibility of business operations failing due to inefficiencies and breakdowns in a firm's internal processes, people, and systems. Human error and external events, such as regulatory changes, are common sources of operational risk. Operational risk can take on additional dimensions in foreign countries from country-specific activities. For example, operational risk incidents would often occur in countries that do not have well-developed infrastructure, in which power outages are common, and computer networks can become disabled. This can be aggravated when civil strife further affects the essential provision of services, such as telecommunications and staff transportation to offices. During civil strife, U.S. bank offices may be targets of protests and subject to physical damage. Local banking customs and practices with less developed risk management controls can amplify operational risk from the potential for higher risk of fraud and corruption. Banks may also have challenges controlling third-party services providers due to less rigid local regulatory oversight and less developed legal frameworks. 5. Regulatory and compliance risks. Regulatory risk is the risk that a change in laws and regulations will significantly impact an institution. A change in laws or regulations enacted by a governmental or regulatory body can dramatically increase the costs of conducting a business, decrease the attractiveness of an investment, or change the competitive landscape. In international activities, banks face compliance risk from the need to comply with local laws and directives that, at times, may vary significantly or be in direct conflict with U.S. laws. For example, a U.S. bank may provide trust services for a foreign government and therefore act in that direction. However, U.S. courts have barred a bank from executing those directives. Another example involves privacy issues, in which local restrictions prevent banks from sharing information on customers even if compelled to do so by U.S. courts or regulatory rulings. The laws and regulations that are most at risk from non-compliance include, 1. The Bank Secrecy Act/Anti-Money Laundering, 2. Information security, 3. Suitability of products, and 4. Outsourcing to third-party providers. 6. Strategic risk. Strategic risks are the potential impact of strategic decisions or a defective or inappropriate strategy. Strategic risk constitutes a lack of responsiveness to industry or sectoral changes. Strategic risk is associated with the future or long-term planning, for example, entering new markets and expanding existing services. As stated earlier, country risk is related to strategic risk. International activities and country-specific activities should be compatible with the bank's strategic goals and direction. A bank should decide in which countries and regions to invest its capital and to what degree. This requires sound strategic planning, effective execution and implementation, and continuing investment in the personnel and systems necessary to maintain a sound and profitable international operation. A bank's management and country risk management staff should have the knowledge and experience to recognize, monitor, and mitigate the risks unique to international activities and identify when changes in the economic, political, or social landscape affect the bank's strategy for that country. For example, strategic risk can increase when banks enter or re-enter a country with a high level of country risk arising from a crisis. Strategic risk will increase if the country is susceptible to a high level of social and political risks. 7. Reputation risk. Reputational risk is the potential for negative publicity, public perception, or uncontrollable events to negatively impact a company's reputation, thereby affecting its revenue. Reputational risk strikes without warning. It shifts a corporate landscape, impacts revenue and sparks chaos. It can also affect customer opinions and organic traffic by weaving harmful content into search results. Reputation risk is inherent in all international activities but can become more prominent if products and services do not conform to local laws and regulations. Banks also can be exposed to adverse opinion and negative publicity by operating in or doing business with countries noted for government corruption, human rights abuses, or military aggression, particularly if viewed correctly or not, as providing the financing for corrupt governments. Banks also face reputation risk in dealing with foreign politically exposed persons or if persons or businesses have ties to terrorist organizations. 8. Information and technology risk. Information and technology (IT) risk is any threat to business data, critical systems, and business processes. It is the risk associated with the use, ownership, operation, involvement, influence, and adoption of IT within an organization. IT risk is any threat to a business data, critical systems, and business processes. IT risks can damage business value and often come from poor management of processes and events. Failure of IT systems due to downtime or outages can result in other damaging and severe consequences, such as 1. Lost sales and customers, 2. Reduced staff or business productivity, 3. Reduced customer loyalty and satisfaction, and 4. Damaged relationship with partners and suppliers. Suppose IT failure affects a firm's ability to comply with laws and regulations. In that case, it could also lead to 1. Breach of legal duties, 2. Penalties, fines, and litigation, 3. Reputational damage, and 4. Breach of client confidentiality. 9. Cybersecurity risk. Cybersecurity refers to the technologies, processes and practices designed to protect an organization's intellectual property, customer data and other sensitive information from unauthorized access by cybercriminals. The frequency and severity of cybercrime are rising, hence the need for organizations to integrate cybersecurity risk into their corporate risk profile. A cybersecurity threat is a malicious act that seeks to damage data, steal data, or disrupt digital life in general. A cyber attack is an attack against the digital devices of an organization through cyberspace. Cyber attacks include threats like computer viruses, data breaches, and denial of service (DOS) attacks. Cyberspace refers to a virtual space that does not exist, but cyberspace is often used for digital weaponry against individuals and organizations' digital devices. Many cyber attacks are mere nuisances, while some cyber attacks are severe. Cyber attacks may potentially threaten human lives. Cyber attacks can cause electrical blackouts, failure of military equipment, and breaches of national security secrets. It can also result in the theft of valuable and sensitive data like personal and medical records. Furthermore, cyber attacks can disrupt phones and computer networks or paralyze systems and make data unavailable. Hence, the need for effective cybersecurity risk management. 10. Emerging risk. Emerging risks are new risks or familiar risks that become apparent in new or unfamiliar conditions. Their sources can be natural or human and often are both a new, Novel, manifestation of risk, a type that has never been experienced. Novel manifestations of risk include entirely new risk types that have not existed previously. Emerging risks may include new technologies, for example, artificial intelligence, AI, nanotechnology or genetic engineering, economic, societal, environmental, regulatory and political change. While some emerging trends are developing slowly, like demographic changes, societal preferences, or cancer research, others can be fast-changing with disruptive potential, like the development of smartphones over the past decade, alternative currencies right now or AI in the future. Slow-moving emerging trends might gain momentum quickly, for example, medical breakthroughs. Consequently, emerging risks are about unclear or changing framework conditions, such as regulatory developments or litigation trends. Thus, while we may think of emerging risks as primarily entirely new risks, as is much the case with new technology, such as blockchain or the gene editing method CRISPR-3, some are known and familiar risks. However, they become new or re-emerging as their contextual conditions change. A field like nanotechnology qualifies as an emerging risk because some risks are known, but they have not materialized fully. We, therefore, consider it a latent emerging risk. Some risks are changing their character dynamically. Consequently, they continue to count as emerging risks. The ever-evolving complex of cyber risks is a case in point. Usually, emerging risks are unquantified, even though they may have a high impact potential for reinsurers and society. The lack of comprehensive data is one aspect of emerging risks' general nature. Hence, emerging risks are not yet fully understood or researched and might lead to surprises or shocks. The early identification of potential changes to the risk landscape is therefore essential. Management of country risks. Foreign investors may be confused about the impact of geopolitics on investment and trade projects. They risk making sweeping decisions about their project, such as pulling out of specific regions or remaining figuratively paralyzed. However, a three-step framework can assist companies in managing their country risk exposures. Here are three significant steps of country risk management. 1. Analyze the current situation in the region. 2. Identify the specific country risk events that might impact the company. 3. Establish strategies to manage risks. Company X is a fictional global publishing company with offices in 11 different countries. It sells books on credit to distributors in Latin America and does business in local currency. Company ABC demonstrates how a foreign investment firm can manage country risk by identifying the specific events from political instability. Now let us discuss the three steps involved in the management of country risks. 1. Analyze the current situation in the region. Peru has experienced a constitutional crisis. In March 2018, Martín Vizcarra replaced Pedro Kuczynski as the president of Peru. The replacement came on the heels of claims that Kuczynski engaged in corrupt practices with a powerful Brazilian conglomerate. Nearly 18 months later, President Vizcarra dissolved a Congress fraught with accusations of endemic graft. Soon after that, he called for presidential elections in January 2020. Claiming that the president does not have the power to terminate Congress, legislators suspended Vizcarra's presidency and appointed the vice president of Mercedes Araúz as the interim president. Within hours of being sworn in, Araúz rejected the designation and deferred to Congress. Peru's most significant constitutional crisis has unfolded in the last 3 decades. With the military's support, Vizcarra remains president, and elections were held in January 2020. 2. Identify the company's unique country risk exposure. Government instability is a precursor to economic instability, and economic instability creates severe risks for foreign investors. Several probable scenarios could impact Company X's ability to implement its business model. 1. Regulatory or direct expropriation. During political and economic instability, host governments often blame a country's problems on foreign investors. In this context, they might seize Company X's assets or use regulatory policies to interfere with its day-to-day business operations. 2. Devaluation. The host government decreases the value of the currency against the dollar. As a result of doing business in Peruvian soles, the value of generated revenue decreases. While Company X could increase prices to offset the devaluation, an ailing economy might preclude schools from paying the increased rates. 3. Currency controls. To prevent capital flight, governments often place restrictions on multinational firms' accounts that preclude transferring funds to organizations, including parents and subsidiaries, in other countries. This prevents Company X from repatriating profits to its bank in the home country. 4. Taxation. When an economy experiences problems, host governments often raise taxes to generate revenue for public services. These taxes are often disproportionately levied against foreign investors. 3. Establish strategies to manage risks. Understanding that economic cycles are inevitable, and the eventual recovery of Peru's sol is likely, decision-makers at Company X remain committed to the Latin American market. After deciding that it would not terminate its investments in the region, the next step for Company X is to manage its exposure to country risks in the region. For this reason, Company X renegotiates its agreement with Peruvian distributors to establish payments in US dollars and develops other strategies for getting its money out of the host country. While Company X is committed to succeeding in Peru, it will scale back its operations during the economic instability by reducing the credit terms to distributors. The decrease in credit terms will likely decrease its margins in the host country, mitigating default risk. Questions for boards on the management of country risk. Boards of directors may want to consider the following questions in the context of the nature of the entity's risks inherent in its operations. 1. When evaluating whether to invest in a new country or region, are risks specific to the country or region carefully considered in the decision-making process? Is the board involved promptly to assess the risks and rewards of making such investments? Does the board have access to expertise in investments in foreign operations to ensure the right questions are asked? 2. When evaluating prospective or current foreign investments, are people with hands-on experience and current contacts on the ground in the country or region in question providing input to the assessment process? Does the company have access to international and local legal counsel who are either currently involved or recently involved with projects in the country or region? Factors multinational firms should consider when faced with high-risk country risk situations. 1. Empower local management. When risky situations arise, vest local management with the responsibility to do what they must do and take necessary steps to protect employees and safeguard the company assets. On-the-ground management understands better than anyone what is happening. They are privy to the cultural nuances that can make or break the successful management of risks surrounding an organization's personnel, operations, and assets during crises. Since companies are morally obligated to ensure the health and safety of local employees and expatriates in a foreign country, local management must ensure that employee safety trumps all other aspects of the business. 2. High risk of confiscation and discrimination emerges when a company is exposed to confiscation, for example, nationalization of the business and expropriation of assets, that can lead to significant investment impairments and some form of taxation, price controls, exchange controls, as well as other discrimination directed to the company that can reduce ROI significantly. Here are actions that can be taken by businesses to reduce their exposure to confiscation and discrimination risks. 1. Repatriate cash. If exchange controls and currency conditions allow repatriation of as much cash as possible, after considering the requirements for sustaining local operations, to reduce the risk of losses due to confiscation. If there is any concern about whether a sovereign could target the company's money, it is best to get the cash home as quickly as possible. 2. Manage down investment. Treat the operation as though it is a cash cow until conditions stabilize and management can better assess its ongoing interests in the country. Avoid any additional capital investments and repatriating much cash as possible. The company should stop replenishing its inventory abroad and look for ways to finance payroll, maintenance, and other operational functions through local cash flow. 3. Divest, disperse and exit. Initiating an exit strategy by divesting assets in the cool of the day is always an option if there is a willing buyer. It is not likely to be a viable option when violence, civil war and anarchy break out. Moving tangible and non-tangible, for example, data files, intellectual property, assets out of harm's way may be an excellent strategy to consider, if feasible. For example, if the company has a fleet of vehicles or heavy equipment close to known hotspots, it may be best to move them to other locations away from the fighting and violence. While distributing valuable physical assets is often an option, it also can create exposure to violence and looting if the present regime involves its police and military forces to protect its interests. While distributing valuable physical assets elsewhere, beyond where a significant the heavy action is expected to be, is often an option, it also can create exposure to violence and looting if the present regime pulls in its police and military forces to protect its interests. 4. Share the risk. While not a guarantee, entering joint ventures with local/foreign partners is a way to reduce exposure to confiscation risk because the presence of nationals can take a multinational under the radar. If cost-effective, political risk insurance is another option covering the risks of confiscation, political violence, insurrection, civil unrest, and discrimination, among other things. Other options may also be available, including passive options like lobbying and maintaining good relationships with local unions. 3. Consider the trends when assessing the risk. Assess similar exposure risk in other countries. The company does business by understanding changes driving forces and taking proactive steps to manage that exposure. For example, watch closely countries besieged with pervasive, entrenched corruption or facing a potential water supply crisis, food shortage crisis and unsustainable population growth. The complexities and interconnections that underpin these global risks can mobilize the masses. In addition, understand a country's balance of payments, likely macroeconomic performance, and fiscal policy. Consider alternative potential scenarios affecting these factors, assessing their impact, likelihood, and velocity, as well as the company's response readiness. 4. Conduct a post-mortem. When an adverse event arises in a particular country, review the assumptions the company had previously formed concerning that country from an economic, political, and financial system risk standpoint. If a consultant was used, what were the research results and what advice emerged from the research? Did the management foresee the event? If not, why not? If management saw it coming, did the organization take steps to prepare? Could the company have done anything differently? A post-mortem provides management with an opportunity to review what happened and determine lessons learned that they can apply to other countries in which they operate. Conclusion. Country risk and the management of country risks have been discussed in this video. The primary objective of managing country risk is to protect company investments in foreign markets and sustain acceptable investment returns. The world and the marketplaces are dynamic and continually changing. Multinationals can expect continued challenges from political instability in the future. Hence, when evaluating whether to invest or sustain operations in a new country or region, risks specific to the country or region should be considered carefully in the decision-making process. The three-step process of country risk management discussed provides an example of how companies can make informed decisions about their international investments. Rather than fleeing a country or a region during instability, companies can use similar processes to understand and manage their risk exposure and make investment decisions based on reason rather than fear. I hope the video is educative and beneficial to you. Which aspect of the country risk management discussed do you consider to be most important? Please post your response below in the comments section. If this video has been educative and beneficial to you, then give it a thumbs up and share it with your friends. Thank you for seeing the risk management of everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.